Let me ask you a weird question. What's in your savings account right now? Cash, maybe a CD, something safe, right? Now imagine you're a country with over $3 trillion in savings. For decades, your savings account was full of US Treasury, bonds, safe, predictable. But what if you suddenly started pulling that money out? Not to spend it on a vacation, but to buy gold bars, stakes in foreign power grids, and the blueprint for a new internet money? Asterisk where China's $3 trillion is actually going. That's exactly what China is doing right now. This isn't just a political headline. This is the world's most powerful investor making a historic pivot. And today, we're not just going to talk about what they're selling. We're going to follow the money trail to what they're buying, and I'll give you a practical, actionable model for what this means for your own portfolio by 2026. First, let's understand the why, because it frames everything. Think of China's strategy like personal finance on a galactic scale. For years, their financial security was tied to the US dollar system. It worked, but it also made them vulnerable. It's like having 70% of your net worth in your employer's stock. If things get rocky, you're in trouble. So they're diversifying. But this isn't just switching from Apple stock to Microsoft. This is moving from financial assets, pieces of paper that promise future repayment, to tangible and strategic assets. Assets they can touch, control, or that give them real-world leverage. It's a shift from finance to physics. And we can see this play out in three clear, somewhat surprising frontiers. Frontier 1. The rush to real stuff, gold and critical commodities. Frontier number 1 is the most instinctual. A rush to own real, physical stuff. The poster child here is gold. While you and I might buy a coin or two, China's central bank has been a relentless, quiet buyer for over 18 months. They're not trading it. They're stockpiling it in their vaults. Why? Gold is the ultimate no one else's problem asset. It's a direct hedge against the very dollar system they're stepping back from. But it goes way beyond bling. Think about what a modern economy and a modern military runs on. Copper, lithium, rare earth minerals. China isn't just buying futures contracts. They're buying the mines themselves. Here's a real-life example. Look at the Las Bambas copper mine in Peru. A Chinese consortium led by MMG owns it. They don't just want the copper when it's dug up. They want the legal right to the ground it comes from. Same story with lithium in Bolivia or cobalt in the Congo. They're securing the physical pipes of the global economy. For them, the asset isn't a ticker symbol, it's a mountain. Frontier 2. From lending to owning, the Belt and Road pivot. Now Frontier 2 is where it gets really clever. For years, China's Belt and Road initiative was famous for lending money to countries to build ports, railways, and power plants, often with Chinese companies as the contractors. It was a giant infrastructure loan program. But the new playbook is different. Instead of just being the bank, they're becoming the landlord and the equity partner. Let's make this real. Take the port of Piraeus in Greece. China's COSCO didn't just build it, they bought a controlling stake. They now own and operate a critical entry point into Europe. Or look at the UAE. China's Silk Road Fund took a major equity position in the UAE's port operator, DP World. They're not just financing logistics. They own a piece of the global shipping network. This is a massive shift. It's the difference between holding Pakistan's government bond, a promise to pay, and owning a chunk of the Gwadar port, where cargo fees are collected, a claim on real profits and strategic influence. They're building an empire of equity stakes in the world's plumbing. Frontier 3. Building the new rules. Digital sovereignty. The third frontier is the most futuristic, and honestly, the most overlooked by traditional investors. China is investing billions to build the rules of the next financial system. This has two parts. First, the digital yuan, ECNY. This isn't just a fancy app. It's a completely new financial infrastructure. They're already piloting it for cross-border oil trades with Saudi Arabia and for salary payments to foreigners in China. The goal? To create a system where global trade can happen in digital yuan, bypassing the US dollar and the SWIFT banking network entirely. The asset here is the entire platform. Second, vertical integration in tech. It's not enough to have rare earths. You need to dominate the whole chain. So Chinese state funds invest in a rare earth mine in Africa, a processing plant in Malaysia, and the magnet factory back in China. They're buying the entire chessboard, not just a few pieces. The investment is in total technological and supply. Chain independence. Your 2026 portfolio. 3 actionable adjustments. Okay, so China is buying mines, ports, and digital systems. What does your investment statement do with that information? You don't copy their playbook, but you can sail in the wings it creates. Here are 3 adjustments to consider for a 2026 ready portfolio. 1. The real asset anchor. This is the most direct translation. Systematically increase exposure to real assets. This means considering a physical gold ETF like GLD as a core holding, not a speculative trade. It means looking at a broad commodities ETF like GSG or shares in the large, globally diversified mining giants, think BHP or Rio Tinto, that will supply these materials, no matter who owns the mine. 2. The strategic infrastructure tilting. Rethink your emerging market exposure. Ditch the generic M ETF. Look for actively managed funds focused on infrastructure and industrial development in key Belt and Road partner regions. Think Southeast Asia, the Middle East, and parts of Eastern Europe. You're betting on the economic growth that this incoming Chinese capital can catalyze. 3. The optional hedge. This is for the satellite part of your portfolio. Take a small 1 to 3% position as a hedge against this digital shift. This could be in a fintech ETF with exposure to digital payment systems, or in an advanced materials technology ETF. It's not a bet on China winning. It's a bet that the system they're pushing against will have to adapt, creating new winners elsewhere. The big picture and risks. Let's tie a bow on this. China is moving from a liquid, financial dollar-based system to a more illiquid, physical, and multipolar one. The risks for them, and for us observing, are real. These assets aren't easy to sell in a crisis. Partners can get buyer's remorse, and big, complex deals can fail. But the signal for us is clear. The tectonic plates of global capital flows are shifting. By 2026, a portfolio that hasn't accounted for this, that's still purely focused on traditional US stocks and bonds, might be missing the new sources of growth and the new shapes of risk. This isn't about fear, it's about awareness. The most powerful move an investor can make is to see the current shifting before it becomes conventional wisdom. I'm curious, which of these 3 frontiers seems most powerful or most risky? To you, the gold and commodities play, the port and rail equity, or the digital yuan push? Let's talk about it in the comments. If this deep dive helped you connect the dots, please hit that like button. It truly helps. Subscribe for more analysis that turns global headlines into portfolio strategy. Next week, we're breaking down how the sovereign wealth funds of Norway and the Gulf are making a parallel, but very different set of moves. Thanks for watching. Invest thoughtfully.